The chair is authorized to declare a recess of the committee at any time. This hearing is titled Modernizing Appraisals, a Regulatory Review and the Future of the Industry. Before we begin, I'd like to thank the witnesses for appearing before the subcommittee today. We look forward to your testimony. And I now recognize myself for 5 minutes to give an opening statement. Many homeowners don't focus on appraisals until something goes wrong or until they can't get one. It's not an area in which Congress spends much time debating or one that the media covers intently. But appraisals are one of the cornerstones of the home buying process. Issues that impact appraisers also impact nearly every American buying or selling a home in rural and urban areas, in high and low-income neighborhoods. These issues affect lenders, home builders, real estate professionals, and ultimately the health of the American economy. And the manner in which appraisals are regulated merits the attention of this subcommittee. The appraisal profession has changed dramatically since the last major regulatory overhaul with passage of FIRREA in 1989. The finance mortgage system has changed and alternative valuation methods are more advanced than ever. Yet when it comes to the regulatory regime surrounding appraisals, it seems we're stuck in 1989. Let's do a quick overview of the system in place today as I understand it. The Appraisal Subcommittee, a body comprised of 7 federal regulators, regulates the standards and requirements of each state appraisal board. The Appraisal Foundation, a non-governmental entity chartered by Congress, promulgates those standards and requirements for the states, but lacks any meaningful regulatory authority. That authority lies in the states, which go through the actual process of credentialing and the appraisers based on the criteria set by the foundation. We've got licensed appraisers, certified appraisers, and certified general appraisers. We've got appraisal management companies that act as a third party in selecting appraisers. This is not a simple regime, and it impacts homeowners. Perhaps as a result of some of this regulatory bureaucracy, the appraisal industry is experiencing a shortage that's beginning to harm the housing market. We're seeing delayed closings and increase in consumer costs. This shortage is hitting rural areas particularly hard, including rural Missouri, which I'm very familiar with. Today's hearing will give us an opportunity to investigate the past, present, and most importantly, the future of appraisal regulation. Personally, I'd like to see a more state-centric model of regulation, one that cuts some of the federal bureaucracy hovering above appraisers today. Beyond the regulation of appraisers, we should look at the current regime, what the current regime requires of lenders, builders, and home buyers. We need to examine alternative home valuation methods that employ the most modern technologies and foster greater consumer choice. We should look at the individuals who should and should not be qualified to do an appraisal and deploy resources accordingly. In rural Missouri, for example, where today there may be 1 appraiser for every 2 counties, there needs to be an alternative. We need to address this in the changing marketplace. Dodd-Frank attempted to address some of the shortcomings seen in the appraisal market, but the law's impact has not enhanced the system for appraisers, stakeholders, or most importantly, consumers. Appraisals are important. They instill confidence and guard against housing markets that could otherwise become depressed. We live in the 21st century, and the market deserves 21st century solutions. It's long past time to examine this model regulation and find a better way. Again, I want to thank the witnesses for appearing before the committee today. Look forward to an open conversation. And the chair now recognizes the ranking member of the subcommittee, the gentleman from Missouri, Mr. Cleaver, for 5 minutes for an opening statement.
Thank you, Mr. Chairman. We are holding this hearing on the role that appraisals play in the housing market, and this will give us the opportunity to discuss changes that have been made to the appraisal system following the Dodd-Frank Act. I think it went into effect in 2010. As we all know, the states are responsible for much of the regulations for the appraisal process, including the certification and licensing of appraisals, as well as the registration of appraisal management companies. The federal government also plays a role in a more general oversight, working to create more uniform standards. And the Financial Institution Recovery Reform and Enforcement Act of 1989 originally sought to oversee appraisal standards, but many of those provisions were updated with the passage of the Dodd-Frank Act, including independent appraisal requirements and the duty to report on appraisers who violate the law. And during the housing crisis, they were many. It's been a hard 6 years since the start of the housing crisis, though this committee has spent a considerable length of time working to staunch the bleeding, and many of the wounds are still healing. The fraudulent inflation of home prices by some dishonest appraisers did, in fact, play a significant role in the housing crash, and it is imperative that we continue to impose high standards to ensure the safety and soundness of the housing market, but also to protect the honest, hardworking appraisers. During the debate over Dodd-Frank, I can remember those seats being taken by individuals who gave us horror stories about what appraisers, some appraisers were doing. But I do think that at least I try to be careful that we don't somehow demean all appraisers. But I believe it is necessary to uphold appraisal independence to ensure that lenders operate independently from appraisers without unduly putting pressure to overinflate prices. I also have a number of questions regarding the alternative valuation methods where computer systems are used to determine the value of mortgages. While Dodd-Frank bears sole reliance on these systems, I do in fact have concerns that a move toward higher use of computerized modeling would be detrimental to the housing market. So I appreciate you being here today, and I look forward to becoming dialogical as the committee hearing goes on. Thank you, Mr. Chairman.
Thank you, gentlemen. Now we recognize the gentleman from Texas, Mr. Green, for the balance of the time.
Thank you, Mr. Chairman, and I thank the ranking member as well. I do believe that we have some room for improvement in this area, and I think that some of the things that I've heard from people who have had actual experiences would merit some consideration. I talked to realtors, I talked to the lenders, and I've talked to the people who actually do some of this appraising, and there appears to be space for improvement. It seems that one of the overriding concerns is a lack of an appeal process, a lack of a process that allows for a dispute to be resolved when it comes to the value of property. And another area of concern appears to be how long will an appraisal stay with the property before you can have another appraisal, assuming that you have applied for an FHA loan. Conventional loans are a little bit different from the FHA loans. These FHA loans are desired for various and sundry reasons. The hard stop on an FHA loan may not be the same as conventional. So people want the better product, but in getting the better product, they're having some concerns that I think we should look at. But I also think that as we look at these concerns, we should make sure that we don't just completely do away with some things that are beneficial. This is the old baby and bathwater argument. I think that there are some things that are beneficial that we have to maintain and should maintain. But I do believe that in a major piece of legislation, there are opportunities to make corrections. They're sometimes called technical corrections. And I would support what the ranking member has said in terms of our desiring to be amenable to looking at some of these things. And I yield back the balance of my time.
Gentleman yields back. Today we welcome the testimony of Mr. James Park, Executive Director of the Appraisal Subcommittee, Mr. David Button, President of the Appraisal Foundation, Ms. Joan Trice, Chief Executive Officer and founder of Clearbox, Mr. Bill Garber, Director of Government and External Relations from the Appraisal Institute, Mr. Ed Brady, Chairman of the Board, National Association of Home Builders, and Ms. Jennifer Wagner, Managing Attorney, Mountain State Justice Incorporated. You'll each be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statement will be made part of the record. And just to give you a little primer on the lights in front of you, green means go, yellow means you got 1 minute to wrap up with your testimony and all the questions that you see around us when we ask you, and red means time to stop. I do have the last say. So with that, Mr. Park, you're recognized for 5 minutes. Welcome.
Good morning, Chairman Lukemeyer, Ranking Member Cleaver, and members of the subcommittee. Thank you for the opportunity to testify before you this morning. My written testimony details the history of appraisal regulation, the appraisal subcommittee, our current operations, and the added responsibility and authority given to the ASC through the Dodd-Frank Act. Given my limited time before you this morning, I will focus my comments on the discussion topics as requested by this subcommittee. First, regarding alternative valuation methods. This is nothing new. The GSEs, lenders, and others have been using them for many years. While technological innovation is needed and should be encouraged, care should be taken to develop valuation techniques that do not rely solely on technology and big data, but also rely on the professional expertise provided by an appraiser. Unlike appraisals, there are no generally accepted standards for development or use of AVMs or automated valuation models, evaluations, or hybrids. Automated tools are manipulated, and over-reliance could lead to misleading conclusions, fraud, and abuse. Automated tools also have limited use in rural and urban areas where data is scarce or unreliable. Second, regarding the appraiser shortage, it appears that economic conditions in certain parts of the country have increased demand for appraisal services. What is not clear is the cause of these localized supply and demand issues, and the veracity of news reports on the topic is questionable. Part of the problem may be that many appraisers refuse to accept mortgage lending assignments due to low pay, confusing or burdensome conditions, fear of blacklisting, and a perception that lenders don't value their opinions. However, I am concerned about the lack of new entrants into the profession compared to the numbers of appraisers leaving. This has been a trend for several years now, and will lead to problems in the future. In 2008, Congress passed the Housing and Economic Recovery Act, HERA, requiring FHA to only accept appraisals performed by certified appraisers and barring the use of licensed appraisers. Since HERA, many lenders have followed suit, effectively removing otherwise qualified appraisers from mortgage lending. This is a particular problem in rural markets. Third, regarding the de minimis value threshold, the federal financial institutions regulatory agencies set the de minimis threshold with CFPB concurrence. Questions regarding the threshold should be directed to those agencies. Fourth, regarding a streamlined federal regulatory regime, the ASC recognizes the importance of a streamlined regulatory system to promote one. Details are in our written testimony. Related to other areas that could be streamlined or improved, standardize the varying requirements placed on appraisers by the GSEs, FHA, VA, federal regulators, and lenders. Today's current cornucopia of statutes, rules, and guidelines, some of which continually change, are confusing and burdensome to all. Require the GSEs to share with appraisers data being collected from appraisal reports through the GSEs portals. Modernize the use of appraisals in mortgage lending. Allow appraisers to provide a reasonable range of values. Low-risk transactions are sometimes denied or canceled when the appraised value is just slightly below the value needed to make the deal work. Lastly, regarding replacing the current system with a state-based regulatory structure. Currently, we have an effective system that draws on the strengths of the states, private sector, and federal government. The system also largely relies on appraisers to regulate other appraisers. Replacing the federal regulatory structure with a state-based regulatory system would greatly complicate, not streamline, the system. Cost to consumers and lenders would increase and unnecessarily burden the mortgage finance system, as states would almost certainly implement varying laws and regulations. There are already examples of this in the states. In conclusion, throughout my career in the private sector and now in the federal government, I've dealt with a complicated array of federal and state laws, regulations, and guidelines, and I can assure you that the industry seeks more standardization, not less. While the current system respects and supports states' rights, I want to impress upon you the importance of a national minimum baseline of enforceable appraisal standards and appraiser qualifications to facilitate. Turning appraisal regulation back to the states would likely be counterproductive, as it would increase regulatory burden and costs and likely further restrict consumer access to purchasing a home and credit in general. Thank you for the opportunity to appear before the subcommittee, and I look forward to answering any questions.
Thank you, Mr. Park. Mr. Button, you're recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Cleaver, and members of the subcommittee. The Appraisal Foundation greatly appreciates the opportunity to appear before you today and to offer our perspective on the regulation of real estate appraisers. By way of background, I've served as a senior staff member of the foundation for the past 26 years and had the privilege of serving on congressional staff for a dozen years prior to that. Let me just begin with a few words about who we are and what makes us different. One, we're a not-for-profit organization that was founded before the enactment of FIREA. We're not an advocacy group or a trade association, but rather an umbrella group that represents about 100 organizations, and they range from the American Bankers Association to the Department of Veterans Affairs, from the National Association of Home Builders to the Department of Interior. Essentially, in the appraisal regulatory system, we are the private sector expertise. We do not have, as the chairman pointed out, we don't have any regulatory authority, but we provide the tools to the regulatory community. For example, we set the minimum qualifications that you need to get a state credential, education, experience. We write the exam that is used by all 50 states and 5 territories. And we also are the authors of the generally recognized standards of conduct, the Uniform Standards of Professional Appraisal Practice, that all state licensed and certified appraisers must adhere to. We have also been a resource to numerous federal government agencies and currently have cooperative agreements with the U.S. Department of Energy and the Department of Justice. To address the points that were referenced in your invitation to testify, I'd like to offer the following. We do have a very unique federal, state, and private sector partnership that has grown and matured over the past quarter century. It is effective and operates solely on user fees paid by appraisers. There are no government-appropriated funds involved in this, and we believe this could be a model for other regulatory programs. Regarding the effectiveness of the Appraisal Subcommittee, the implementation of a rating system of the state appraiser regulatory programs and the appointment of policy-level representatives to the subcommittee have been very positive steps in recent years. However, we believe there are a few opportunities for improvement in its current structure. Dodd-Frank and its impact on the current regulatory system, stakeholders, and consumers. The focus on appraiser independence, the regulation of appraisal management companies, and the elimination of some predatory lending practices were all positive outcomes. However, there have been several unintended consequences of those decisions, which we look forward to discussing with you today. The de minimis threshold in federal-related transactions. According to the National Association of Realtors, the average sale price of an existing home is $230,200. The current level of the de minimis is $250,000. You can make the argument it's already too high, and we're certainly in opposition to any increase to the $500,000 level. We also believe that efforts should be made to restore the definition of what constitutes a federal-related transaction, back to what Congress originally intended when FIREA was enacted in 1989. A shortage of appraisers. There's no question that there is currently a shortage of appraisers in certain markets. It's not a national shortage, but in certain markets, particularly rural areas and areas that have seen an uptick in mortgage originations, there is a shortage. There are several reasons for this, no one reason, and I look forward to sharing those reasons with you this morning. Appraising in the 21st century, as long as we have a collateral-based lending structure, there will always be a need to determine the underlying value of the security for a loan. While we may have entered the age of big data, the analysis of that data by a trained valuation professional has never been more important. An example for that would be what happened 9 days ago. The day before the election, we all were exposed to a great deal of very precise data, and we all learned 24 hours later it was not accurate data. So that's an example of where you trust the numbers, but you need some human intervention there. In conclusion, today we may hear testimony that will contain proposals that range from creation of a new large federal bureaucracy to one that all but eliminates federal oversight. The current Title XI real property appraiser regulatory system, while unique and not without its flaws, it's made a real positive difference over the past quarter century. It promotes consistency among the states due to the appropriate federal oversight. It has instilled competency by ensuring that we have meaningful standards and qualifications and a uniform national exam, none of which existed before the enactment of FIREA. And it operates at no cost to the taxpayers, and there are no federally appropriated funds. Appraisers have historically made a significant contribution to the safety and soundness of our financial system, and their important role will continue in the future. The catalyst for the creation of this current appraiser regulatory system was to protect the integrity of the Deposit Insurance Fund, a need that is as strong today as it ever was. The Foundation stands ready to assist with any effort to make the current system more efficient. Again, we appreciate the opportunity to share our perspective with you, and we urge this subcommittee and all members of Congress to continue to use the Foundation as a fair, impartial, and objective resource. Thank you very much.
Mr. Bunn, you are very, very good. That was exactly 5 minutes. That is amazing. Thank you very much for your testimony. Ms. Trice, you're recognized for 5 minutes.
Chairman Lukemeyer, Ranking Member Cleaver, and members of the Subcommittee on Housing and Insurance, thank you for the opportunity to share my thoughts regarding modernizing appraisals, a regulatory review, and future of the industry. My name is Joan Trice, and I am speaking on behalf of no one in particular, but anyone who desires to uphold appraisal independence. Today, all stakeholders suffer from appraisal regulatory regime that is outmoded. The housing finance crisis shed a bright light on the systemic failures of the appraisal process. The structural flaws of the regulatory schema reveal a system whereby no one was held accountable. This illustration of the current regulatory system says it all. It should be no surprise that given the above diagram that the appraisal industry is being highly scrutinized. It is entirely dysfunctional. It's time for big and bold, a plan to overhaul the system. The appraisal profession needs a single authority to take ownership of the policy, process, practice, procedures, and the people who are licensed. National licensing is needed with oversight at the state level. States must adopt a standardized process for investigation and adjudication of any disciplinary actions. Peer review and rehabilitation of the appraiser should occur at the state level. This new entity should not carry forward any of the legacy agencies that exist today. The times call for a fresh, holistic solution to replace the disjointed, ineffective structure that currently exists. Repeal FIREA Title 11 and replace it with this new independent agency. Independence is the cornerstone of the appraisal process. The Home Valuation Code of Conduct and subsequently the appraisal independence requirement components of Dodd-Frank left an indelible mark on the appraisal profession. For the last 9 years, practically every single stakeholder has done their best to avoid compliance with the appraisal independence requirements. Appraisal is truly the weak link, and our current policies and systems continue to diminish the important role that appraisers play in the housing finance ecosystem. Discussions of shortages, poor quality, cost, delayed delivery of appraisals, and the de minimis threshold are all code for efforts to diminish the role of the appraisal process. The events of the presidential election offer a cautionary tale. Big data failed, models failed, bias and lack of independence by the analysts failed. Fannie Mae and Freddie Mac would have you believe that they hold all the marbles. Once again, they are competing with each other by reducing appraisal requirements. This is a race to the bottom, and we've seen this movie before and we know how it ends. Do not think for a minute you can replace appraisers with push-button technology. Appraising is part art and part science. Create a system whereby well-trained ethical appraisers have access to reliable data and afford them the independence to play their important role. In conclusion, if Congress is truly serious about the safety and soundness of the housing finance system, then there is only one clear path for the appraisal process to thrive. Establish a single authority over real estate appraisal. The white paper entitled Re-engineering the Appraisal Process I provided explores in greater detail solutions to bolster the appraisal profession. Thank you for the opportunity to share my thoughts on this important topic.
Thank you, Ms. Trice. Mr. Garber, you're recognized for 5 minutes.
Chairman and members of the subcommittee, on behalf of the largest professional association of real estate appraisers in the United States, thank you for holding this hearing. Real estate appraisal plays a critical role in the American economy by helping financial institutions conduct risk management and make safe and sound loans. Today, the number of appraisers in the United States is on the decline, and banks and real estate professionals are expressing concerns about a potential shortage of appraisers. Appraisers routinely are being buried by rules and regulations in nearly every facet of their business, from how an appraiser reports an appraisal to supervising trainees, uneven licensing requirements to licensing and registration fees passed down by clients to mandates from federal agencies, appraisers' professional lives have become overly complicated, more expensive, and less productive due to a dated and archaic regulatory structure that needs to be revised and updated to reflect today's market. Real estate appraisers face a layering effect of rules and regulations that create a disincentive for potential entry into the profession, while also diminishing the profession's profitability. This is counterproductive given that rules and regulations continue to grow in number every year. These include background checks with no federal mandate or efficient processing system, unappealing supervisory appraiser and trainee appraiser requirements, and constantly changing rules and standards. While we appreciate the role and function of the various organizations and agencies that have been part of the appraisal regulatory structure since its beginnings in 1989, the appraiser regulatory structure today is overly complicated. The primary functions of the appraisal subcommittee can and should be performed more efficiently and without perpetually taxing appraiser practitioners and users of appraisal services. And the Appraisal Foundation's role in setting standards and qualifications, a role it has carried out reasonably well, should be unimpeded by unrelated activities. In short, the continuous state of change forced on the profession can be simplified and made more accountable. As such, the Appraisal Institute believes there is a better, less complicated approach that would improve appraisal quality, reduce costs, and address fundamental concerns that are driving away appraisers from the profession. We believe that our proposed model would benefit from the combined experiences of other industries and precedents established by Congress. Specifically, we suggest that Congress modernize the appraisal regulatory structure and align it with those in the real estate and mortgage industries using a model like the nationwide mortgage licensing system, cooperative amongst state agencies. Authorizing the appraisal profession to utilize a system like the NMLS for its certification and licensing system would enable state appraiser regulatory agencies to benefit from enhanced communication with other state agencies, including those outside of appraisal, such as state banking regulatory agencies. Such a realignment would also provide a common system for appraisers to submit applications for licensure in multiple states. Today, appraisers who wish to earn and carry licenses in multiple states must separately apply in each state, significantly adding to administrative requirements and obligations. The most direct example of the benefits of such a system involves background check requirements that currently are being imposed on appraisers on a state-by-state basis. Several years ago, the Appraisal Foundation established a fingerprint-based background check requirement for states. Today, 47 states now have in place a requirement for formal background checks. Many states impose similar requirements on existing credentialed holders in real estate appraisal, many of whom had been practicing in good standing without any issues for many years. A few states even went so far as to impose these requirements on appraisers practicing in other states who applied for a license via reciprocity or a temporary practice permit. Even though the Appraisal Foundation had the best intentions, it eventually backed away from this requirement, acknowledging that it had erred. Now it is unlikely that states will repeal or change the existing requirements anytime soon. Under an NMLS-like system, such background checks could be performed and shared by all participating state agencies, helping to significantly shave an burdensome administrative expense. In conclusion, the Appraisal Institute is not suggesting eliminating all federal involvement in the appraisal regulatory structure, but rather repositioning it to align with regulatory systems of other related industries. Should states fail in their responsibilities to manage appraisal oversight, a specified federal agency like the FDIC or FHFA could be authorized to set up a backstop system, just as the statute recognizing the NMLS does today. Such a system simply would reposition the federal role to one of a backstop authority or one of last resort. Presently, real estate appraisers pay for the operation and maintenance of the regulatory structure through license renewal fees, course requirements, and mandates to purchase the volume of rules and regulations. After almost 27 years of FIREA, it is time to make the appraisal regulatory structure and process more efficient and responsive to the needs of practitioners and consumers. The Appraisal Institute applauds the Congress's review of the FIREA statute with an eye towards modernizing the appraisal regulatory structure, and we stand ready to assist you in any way we can. Thank you for giving us the opportunity to testify today, and I would be happy to answer any questions.
Thank you, Mr. Garber. Mr. Brady, you're recognized for 5 minutes.
Chairman Lukemeyer, Ranking Member Cleaver, and members of the subcommittee. I'm pleased to appear before you today on behalf of the National Association of Home Builders to share our views on the regulatory structure of the appraisal industry and suggestions for ensuring efficient and effective collateral valuation. My name is Ed Brady, and I'm a home builder and developer in Bloomington, Illinois, and sitting here as NAHB's 2016 Chairman of the Board. The housing recovery has been impeded by ongoing problems in the U.S. residential appraisal system. While lenders, federal banking regulators, and federally related housing agencies implemented corrective measures in response to valuation breakdowns in the wake of the Great Recession, and Congress mandated additional measures in the Dodd-Frank Act, these steps did not address fundamental flaws and shortcomings of the residential appraisal framework. Improper appraisal practices, a shortage of experienced appraisers, and inadequate oversight of the appraisal system continue to restrict the flow of mortgage credit and retard the housing recovery. NAHB is not advocating that appraisals should be higher than the market. Rather, our goal is to establish an appraisal system that produces accurate values through all phases of the housing cycle. The focus of reforms to date have been on eliminating undue influence on appraisers to produce inflated valuations. However, when home prices began declining, improper appraisal practices exacerbated the slide in values. Some appraisers used distress sales, many of which involved properties that were neglected and in poor physical condition, as comparables in assessing the value of a brand new home, without accounting for major differences in condition and quality. Without such adjustments, the two housing types are just not compatible or comparable. As the housing market has improved, builders face new appraisal challenges, specifically the lack of data on new construction, a shortage of appraisers experienced in appraising new construction, and no practical way to appeal a faulty appraisal. Getting more new home transactions into multiple listing services databases would be a simple solution for the lack of data. NAHB is presently engaged in that discussion, and this we hope to have results soon. The dramatic increase in the use of appraisal management companies, or AMCs, has led to more activity by appraisers with less training and experience. This is problematic for new home construction transactions, which by their nature are very complex. Appraisers must be able to analyze detailed plans and specifications, determine the value of options, including state-of-the-art energy efficiencies, find appropriate comparables, and factor in land values. One way to improve the quality of new home valuations is to strengthen education, training, and experience requirements for appraisers of new home construction. The biggest flaw in the current appraisal system is the lack of workable appeals processes. Current valuation practices do not provide a process for expedited appeals of inaccurate or faulty appraisals. Buyers and sellers, builders and real estate agents can be held hostage by the current inability to promptly address legitimate questions on a valuation. NAHB recommends the adoption of a standard appraisal appeals structure similar in design to the one utilized by the VA. Finally, the current residential appraisal system continues to face many challenges due to inconsistent and conflicting appraisal standards and guidance, as well as the inadequate federal oversight. NAHB believes that fundamental appraisal system reform must be a principal element of efforts to rebuild the nation's housing finance system. Coordination and accountability currently are lacking, and there are major gaps in the system. In closing, collateral valuation is a critical component of the mortgage decision. While there have been a number of positive changes to the appraisal system since the financial crisis, there remain a number of unresolved issues. NAHB stands ready to work with this subcommittee, along with appraisal, housing, and financial stakeholders, to address the real challenges we face in restoring the public trust in how we build, transfer, value, and finance American consumers' most valuable asset, their home. Thank you, Mr. Chairman.
Thank you, Mr. Brady. Ms. Wagner, you're recognized for 5 minutes.
Thank you, Chairman, Ranking Member Cleaver, and members of the subcommittee. On behalf of Mountain State Justice, the National Consumer Law Center, and the National Association of Consumer Advocates, thank you for inviting me to testify today. I'm the managing attorney of Mountain State Justice, a nonprofit legal services provider in West Virginia. Since the early 2000s, we've served thousands of homeowners in danger of losing their homes as the direct result of appraisal fraud and other predatory lending practices. I'm here today to thank Congress for imposing stricter new standards for appraisals under the Dodd-Frank Act. These new standards have dramatically reduced appraisal fraud, in turn saving countless of homeowners from foreclosure. It's common knowledge that lax regulation of the mortgage and appraisal market led directly to the devastating financial collapse of 2008. Before the collapse, profit-driven brokers and lenders worked with appraisers to fraudulently inflate home values. Lenders made more money from larger loans, and they rewarded appraisers willing to hit target values with repeat business and sometimes even kickbacks. Many of these loans contain features that would cause the homeowner's payments to skyrocket after a short teaser period. Even before the market collapsed, consumers and their advocates began to see this house of cards topple, as homeowners trapped in these underwater loans were unable to refinance when their payments spiked up. Thousands and soon millions of homeowners faced foreclosure. Surely we all remember this. In my organization alone, for years, every single week, we saw dozens of homeowners facing foreclosure because of appraisal fraud. Appraisal fraud is why one of my clients, I'll call her Ms. R, came into my office desperate to save her home. Ms. R had tried to refinance for a lower fixed interest rate after her payments skyrocketed. She was denied because her loan was so underwater, and now she faced foreclosure. How did this happen? A broker appraiser team preyed on her, repeatedly flipping her into loans of ever-increasing amounts. Then a phone salesman for another lender called, promising her lower payments. This lender didn't bother with an appraisal. Instead, it used an automated valuation model, which provided a grossly inflated valuation based on flawed data. This inaccurate computer model inflated the value of Ms. R's home by nearly 300%. Ms. R was trapped. The conduct that pushed her to the brink of homelessness also led to the devastation of 2008, when millions of homeowners lost their homes and banks failed across the country. The regulations adopted by Congress in response were absolutely necessary to prevent a repeat of the same devastating events. The Dodd-Frank Act increased regulation of appraisals, building on the necessary safety and soundness requirements passed after the savings and loan crisis. Dodd-Frank has ended the practice of appraisal fraud, primarily by requiring appraisals to be independent, as well as accurate and conducted in person by qualified appraisers. These reforms help keep homeowners informed about the biggest financial decisions they will ever make. They also protect lenders and investors and insurers by ensuring that they have the collateral necessary to protect their risk. There's no doubt that these reforms have been a success. Weakening these standards, including allowing lenders to rely on alternative valuation models or eliminating appraisal independence controls, will return us to the recent era of unreliable reports that ultimately upended the market. The existing baseline of federal lending and appraisal standards is necessary to ensure that consumers and the entire financial market are uniformly protected from both fraud and from unintentional error. The savings and loan crisis of the 1980s, and then the economic collapse of 2008, showed the urgent need for these common sense rules. Eliminating these minimum federal protections and instead relying solely on the states would open the door to more economic crises that devastate homeowners and financial institutions alike. In sum, Congress wisely adopted the current federal appraisal protections to protect the American dream of homeownership and financial stability. Without these protections, we face the risk of a new financial crisis, even while we've barely recovered from the last one. I urge you to keep these essential protections in place. I'm happy to answer any questions. Thank you.
Thank you, Ms. Wagner. With that, we'll begin the questions, and I'll recognize myself for 5 minutes. Mr. Garber, you made a couple comments with regards to some of the appraisal subcommittee and the appraisal foundation. I guess so my question is, do you believe both those entities are relevant?
Thank you for the question. These are two different entities, so I think they should be treated separately, separate discussions altogether. With regard to the appraisal subcommittee, we do see that the role that's being played by the subcommittee today is essentially been accomplished as far as its mission and goals. State appraisal boards have been licensing appraisers for many years, and they're doing a very good job of processing appraiser licenses and certifications, and they're doing a base level of enforcement. This has been going on for some time, and by the appraisal subcommittee's own records, they have grading state appraisal regulatory agencies very well. There's no state that's at risk of compliance burden. The issue with the appraisal subcommittee is that it's set up by FIREA, which is, the way it is structured, it results in an ever-increasing set of regulations on top of appraisers. It's an oddity in
the... That begs the question then, do you believe the regulatory system for appraisers needs a federal regulatory body?
We think that the federal role should be repositioned to that of a last resort. So right now, the appraisal subcommittee is odd in that it actually audits independent or sovereign state agencies. We find no comparable for this in the marketplace today in any regulatory aspect, where the federal government is actually auditing state agencies. So we're suggesting that that be aligned with those recent precedents that have been enacted by Congress, like the NMLS, which puts the burden on the states. The states have to maintain that job, and as long as they're performing at a high level, then they're allowed to do that. But there's still a federal role, but it's one of a last resort.
Okay. Mr. Park, would you like to respond to that?
Sure. The regulatory system that we have in place now recognizes states' rights. And what the appraisal subcommittee does in terms of our compliance reviews of the states is we review the states to make sure that they are in compliance with Title VII, which includes the AQB minimum criteria, that they've implemented USPAP, and that they are in compliance with those minimum baselines. Again, it's key to have that minimum baseline for the states to adhere to in order to facilitate commerce. Otherwise, without that minimum baseline, you're going to have the states go in 55 different directions, and it's going to increase the costs and burden on mortgage lending significantly.
Okay. I have a very good friend of mine who is an appraiser, and I had a long conversation with him just last week. And his comment to me was that he didn't know how any person could ever get started in the appraisal business today because of the difficulty of getting licensed and finding your own business. The business model is not, and I come from rural Missouri. I'm about as rural as you get, town of 300 people. But he lives in a town of about 30,000. But the problem is, as a number of you indicated here, that there is a shortage. There's a shortage in my area. And while I recognize 08 pointed out some problems, has Dodd-Frank caused the rules that came out of Dodd-Frank, has the pendulum swung so far that now we are winding up with a shortage, that the restrictions in Dodd-Frank are such that it is squeezing the appraisal industry to the point where we don't have people being able to get in it? And if so, that's a problem. And how do we fix that? Excuse me. One of you want to tackle that, Mr. Button? Yeah.
A couple issues regarding the shortage. One, Dodd-Frank and regarding the appraisal management companies. I think a lot of lenders felt that they were compelled to establish appraisal management companies. And what's happened is, because of their focus on a lot of them, there are good AMCs, but a lot of them are maybe not as good. They focus on the cost and the turnaround time. So there's a shortage of appraisers who are willing to work for that fee. We still have a lot of appraisers. We have more certified appraisers today than we did 10 years ago, but they don't want to work for that fee. The other impact is that the licensed appraisers in the United States, when FHA, through an act of Congress, said that we can only use certified appraisers, that had a huge impact, particularly in rural areas where you had licensed appraisers. The number of licensed appraisers, excuse me, 10 years ago there were 29,000, just under 30,000. Today there are 7,900. And so there's been a huge drop in the license category. Lenders don't want to use licensed appraisers or trainees, and that creates the problem that your friend talked about at entering the market. Banks used to be the training ground for appraisers. Now they've outsourced it, and since banks don't want to use trainees or licensed people, people don't want to bring on trainees because they're not really good. Thank you.
Very good. Appreciate your comments. My time has expired. With that, we recognize the gentlelady from California, Ms. Waters.
Thank you very much, Mr. Chairman. Today, we're examining proposals to fix our current system of regulating and overseeing appraisals, but is there really any reason to believe that it's broken? To the contrary, it seems that we have substantial evidence to demonstrate that our current system, in particular, the important reforms brought about under Dodd-Frank, has been largely successful in streamlining standards across the country and protecting us against the kind of harmful appraisal fraud that we saw leading up to the housing crisis. While there's always room for further improvement, I don't see any reason for a complete overhaul of our current system, as some have suggested we need. So I'd like to get some comments. Ms. Wagner, Freddie Mac recently announced that it plans to dispense with traditional appraisals for some mortgages and replace them with automated valuation models, AVMs. Further, Mr. Park's testimony supports the use of different valuation products according to the risk characteristics of a loan. Can you talk about some of the risks that AVMs can pose to consumers and the financial system? Do you think that AVMs could be appropriate for some lower risk loans, as Mr. Park has suggested?
Thank you for the question. First of all, I do agree that if, as they say, if it's not broke, don't fix it. And I don't think that we're broken. In fact, I think that we're engaged in fixing what happened before. AVMs do give me significant concern, and they give the appraisers that I've talked to, as well as my homeowner clients, those same concerns. They just can't be fully accurate. If you use a computer valuation model, you are not getting the input of actually going out to the house and seeing whether there's been any kind of damage to the interior of the house, and you're also not getting the input of if someone's made substantial improvements to the house. There's no standardized method for AVMs, and a lot of the data inputs are simply inaccurate, coming from tax data that's outdated, and from the use of comparables not based on actually seeing whether those properties are comparable, but just sort of inputting from the area. In a lot of places, there's tremendous diversity in housing. It's not just subdivisions. And one example is a client of mine who lived on a road right next to a subdivision. An appraiser in that case used comparables from the subdivision that were much closer to her house than houses that were actually much more like her house. An AVM model would do that same exact thing without any kind of oversight. So you can't see the property appeal, you can't see the unusual characteristics of the property, you can't see any kind of damage, infestation of rats, anything like that, and you can't see any kind of improvements. So it does greatly concern me.
Well, thank you very much, and I believe exactly what you said. First of all, I like independent appraisals. I like small businesses. I don't like the way the system may be run now with the management, appraisal management companies, and taking a fee or cut, from the appraisers. But let me ask you, because I think there's room for dealing with still some potential fraud. If the lending institutions are owning still some of these appraisal units in their business, I think that's a problem. I'd like to get rid of that. But let me just, agree with you in saying that the work that was done in Dodd-Frank really did get rid of a lot of the problems, a lot of the fraud. I see no reason at all to be talking about getting rid of Dodd-Frank. With all due respect to Mr. Lukemeyer, you're absolutely right. There's no way that these models, these AVMs, can determine what that house really is, what it really looks like, where the damage is, et cetera, et cetera. And again, I think as I was coming in, I heard some testimony from someone that talked about the recent big data problem that we've seen in the election and on and on and on. Get rid of that crap. Leave the human element in appraisals. And so with that, thank you for your testimony here today. I agree with you 100%, and I yield back the balance of my time.
Lady yields back. With that, we go to the gentleman from New Mexico, Mr. Pierce, recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Bunton, where does the Appraisal Foundation get its funding?
The majority of our funding is through publication sales, the book of standards, coursework, material like that. We receive a grant from the Appraisal Subcommittee for $350,000, the current grant level, and our budget's about $4.2 million.
Okay. Mr. Park, you heard Ms. Wagner's testimony. It said that basically the bubble in housing prices was not created by just by a spike in consumer demand, but as a result of intentional fraud and lack of oversight. So that seems to be sort of directed at your function to me. I mean, I have to confess I'm a little bit confused by, I think Mrs. Trice's chart shows why I'm a little confused about what's going on, but so is her statement a reflection of the oversight that you bring?
Well, her statement, the states are the ones that regulate appraisers.
No, but you oversee the states, and you're supposed to, it says in your document that you can bring actions if a state is in noncompliance. So surely the federal government doesn't say that it's okay to create fraud, and the states don't say it's okay to create fraud, so you would expect there would be something that would show up if the amount of fraud is there. So I'm just asking, is that a fair assessment of your oversight?
The Appraisal Subcommittee's role is to oversee the states in regard to acquiring,
sir, with all respect,
Title 11.
You oversee the states, but you say on page 8 that you have the right to bring action in the case of noncompliance or order of non-recognition. Does that mean that you don't have oversight of the states? You don't?
We do have oversight of the states.
And you can't do anything
We would
about it.
take action if a state is not complying with Title 11.
So you're saying the fraud that was the fraud that was suggested by Ms. Wagner was then approved under Title IX. That's what I would have to draw the conclusion if you didn't find any reason to bring an action. It says you got the right to bring the action in your own document.
Generally speaking, if there is a fraudulent appraisal, there is going to be a violation of the Uniform Standards of Professional Appraisal Practice, USPAP, involved in that fraudulent activity. The states are the ones that handle complaints and adjudicate complaints in regard to fraud in their state or violations of the uniform standards.
So if there's fraud going on that was alleged there, then you have no say-so.
We have to work within the purview of the law.
So have you ever brought an action against a state?
We have never taken a non-recognition action against the state, which prior to 2010, the Dodd-Frank Act was the only action that the subcommittee could take against the state, which would be a very dramatic and draconian action. The subcommittee has chosen for the past 25 years to work through the partnership with the states and with the foundation to correct.
But you've never taken an action.
We have not taken.
You have not taken an action, and yet, according to Ms. Wagner, fraud was the reason for the bubble.
And the Dodd-Frank Act gave the subcommittee additional regulatory authority to take actions in lieu of or short of a non-recognition process.
You've gotten that additional permission, and have you done anything under that?
We have not found
Okay,
the
that's all I need
need
to know.
take any further action.
Ms. Trice, would you like to address this? Because this seems like no one is in charge of anything that we're going to oversee, but we're really not going to take any actions. Would you like to make an address on this?
Yes, please. I think the consumer is the one who gets punished the most by this regulatory structure that I've diagrammed here. So if a consumer has a problem with the appraisal, and the NEHB pointed this out as well, if someone needs to make an appeal, there is not a efficient, effective process. So if it's immediate, let's just say there's a appraised value falls short of the contract price, the consumer can only make an appeal to the lender. If they make an appeal to the state...
Let me ask one more question if I can. Mr. Garber, in your opinion, what would happen if ASC didn't exist at all?
Well, states would continue to do licensing and enforcement, so we're not suggesting that that go away.
I didn't ask. I'm asking from my perspective, and my time's about shot.
Yeah, from right now, the appraisal community would have a less burdensome regulatory environment. It would be a more attractive proposition to enter the profession because we'd have fewer rules and volume of layering effect that's currently occurring under the current regime.
Okay,
that's important
thank
to
you.
the rural markets.
All right. Thank you. Thank you, Mr. Chairman, for your indulgence.
Gentleman's time has expired. With that, go to the gentlelady from New York, Ms. Velasquez.
Thank you, Mr.
Recognize
Chairman.
for 5 minutes.
Thank you. I would like to address my first question to each member of the panel. Given that automated valuation models are playing an increasing role in residential valuation, and the number of appraisers is dwindling, the appraisal landscape is changing quickly, regardless of regulation. What do you see as the role of appraisers 10 years from now? Mr. Park.
The appraisal profession is still and will continue to be a very important cog system in the United States. Automated valuations, automated tools can only go so far. You don't realize how big this country is and how diverse the housing is in this country until you start trying to place appraisal orders all over the nation. There are certain areas where you have homogeneous property types where automated tools are useful. But I would submit that those tools should not be left alone so that a computer is generating the valuation without an appraiser's expertise being involved. So the future is appraisers will have to adapt to of technology, lenders will have to adapt, and so will regulators.
Thank you. Mr. Bond.
Automated valuation models are a tool that appraisers use. That's all they are. And there may be an application for them, as Mr. Park points out, with homogeneous housing stock, with a very low loan-to-value, those types of things. But as far as 10 years from now, you're still going to need a valuation professional to sift through all the data. They will probably perform more appraisals in a day than they do today because they'll have access to a great deal of information just sitting at their desk. But you're going to need that human interface of a trained valuation professional to make determinations, particularly in areas where you don't have a homogeneous housing stock.
Thank you.
There's two basic components to an AVM. One is the data, the second one is the algorithm. So today, we have a very poor database, frankly. We have no inventory of every piece of property in the United States. So we have MLS data, which is essentially sales data, which is, how do I say, flowery sometimes. It's not necessarily factual. And then we have public record data, which varies from state to state and county to county. So in essence, we don't have very good data. In theory, AVMs in the future could become more reliable, but today's market, they are not. And just a reminder, human beings write the algorithms. So it's nothing more than an opinion cloaked in a mathematical formula.
Thank you.
Thank you for the question. Big data in general has the potential to enhance the valuation process if it's looked at closely and there's trained professional evaluation of the methods that are used. Right now, there are appraisers that are integrating big data into their own appraisal reports, and I think you would maybe surprised that a lot of appraisers are actually very technologically savvy today. I think our biggest concern is we don't see that our regulatory structure is really positioned to allow and enable appraisal professionals to provide the full range of services that the user community and consumers really are looking for. There's a full range of demand for valuation services. Loan purchases is a big one, but it's not the only one. You have refis, you have workouts, you have the ability or the need to do monitoring of entire portfolios. Right now, our estimates indicate that there's 4 evaluations performed for every single appraisal in the market today. Right now, appraisers are not involved in the majority of the valuation services that are being engaged by financial institutions. We want to position our regulatory structure so that it's more responsive to those needs.
Thank you, Mr. Brady.
Very quickly, data is important, especially in our segment of the industry in new construction. It changes every day. It relies on code changes, it relies on energy and efficiency, so the human touch is always going to be an element. I think the AVM is a resource, but we should not rely, especially in our segment of the market, on AVMs.
Thank you, Ms. Wagner.
And very briefly, I do think I addressed this question a little bit, but I think looking ahead into the future, it just highlights the need for careful regulation and a federal structure in order to ensure that there is some consistency and safety in the marketplace. So if we do end up using these models slightly more, it should be balanced with actual appraisals, and we do need some oversight to make sure it's done fairly and safely for everyone.
Thank you. Thank you, Mr. Chairman.
Ladies, time's expired. Got a great discussion going here today. Thank all of the panel for their concise answers. With that, we go to Mr. Rothfuss from Pennsylvania. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Garber, while I understand that a national appraiser shortage may not yet be here, though industry trends suggest that one may be coming soon, we all seem to agree that localized shortages are a problem, especially in rural communities. My district includes a number of rural communities, and I was hoping to get a better understanding of how this dynamic may impact my constituents. Can you describe how localized appraiser shortages may impact communities such as those in rural Pennsylvania?
Yeah, thank you for the question. Appraisers, as I was saying, are facing a layering effect of rules and regulations right now, and it's never ending at this point, where there's no bounds around the current regulatory structure. So as an example, we've seen proposals and actually, in effect now, programs to codify appraisal methodology, where appraisers not just have to follow a certain standard, but are being obligated to follow methods and techniques such as the cost approach or the sales comparison approach or the income approach in the appraisal process and follow it along a strict guideline.
Where would that be coming from?
Well, it came from a proposal that came from originally directed by the Appraisal Subcommittee for the Appraisal Foundation to undertake. And that has resulted in the creation of a third board under the Appraisal Foundation called the Appraisal Practices Board. That board has a very unclear role in today's marketplace. But I'll give you an example of how it's being used. State regulators have already identified this as a document or a set of materials that they're using in enforcement cases. So appraisers have to keep that in mind as they're developing their appraisals. And just last week, I was talking with an official at Freddie Mac. Freddie Mac issued a bulletin last week on green and energy efficient appraisal issues. Within that bulletin, those documents are actually referenced. In talking with the Freddie Mac official, they indicate that those bulletins are actually part of the contracts that they have with loan sellers to Freddie Mac. Those are now effectively part of the contract when a lender sells a loan to Freddie Mac. They don't realize it, but that's an unauthorized board of the Appraisal Foundation today. But their lenders are going to be obligated to follow all of that information to a T. And in your rural market, every market's different. So the rules or the guidelines that work in Washington, D.C. may not work in rural Pennsylvania because every market's going to be different. That's why we need to have more flexibility to the methodology.
Would you think that if you're seeing some shortages appearing in some areas, rural areas, could those trends eventually get to other areas?
Oh, absolutely. I think I provide some information on the projections ahead. We do see the potential for a 20 to 25% continued reduction or a further reduction over the next 5 to 10 years. What is troubling to us is that there are fewer appraisers that are interested in entering the profession. They're facing all of these rules, regulations, fees. Right now, the Appraisal Subcommittee is about ready to finalize a rule to implement an appraisal management company registry fee. The process that was used to undertake that rulemaking failed to consider the impacts on small businesses. The reality is that rule is going to impose significant fees on small business appraisal service providers because they're going to be passed through from the appraisal management company directly onto the heads of practitioners. If you're an appraiser, you're looking at this system, you're stepping back and you're reconsidering the proposition today. And that's what troubles us as a leader within the appraisal profession. We need to reposition this to make it a more attractive endeavor.
If I could move over to Mr. Park, alternative valuation models or methods have been used by the appraisals industry for many years. In your testimony, you seem to support the use of new methods and new technologies based on improved data, yet you caution against moving completely away from an appraiser-based process. Could you describe for which types of transactions alternative valuation methods such as automated models might be most appropriate?
Yes, thank you for the question. As I stated earlier, in areas of the country where you have a more homogeneous housing stock, where you have good quality data, coupled with a low-risk transaction. When I say a low-risk transaction, an example would be a rate and term refinance where a borrower is simply their rate from 5% to 4%, something like that. They're not taking cash out. There's no additional risk in the transaction. Borrower has a good credit score and so forth. They pose a good credit risk with little likelihood of default. Those are transactions where an AVM could be useful, again, with human intervention in terms of making sure that the results of that AVM make sense.
Yield back. Thank you, Chairman.
Gentleman yields back. With that, we go to the ranking member of the committee, Mr. Cleaver from Missouri.
Thank you, Mr. Chairman. Ms. Trice, do you like hamburgers?
Excuse me?
Do you like hamburgers?
Hamburgers? Love hamburgers.
You prefer mustard or mayonnaise?
Neither.
What do you prefer?
I like ketchup.
Ketchup. I don't. But I delivered a speech in the Boot Hill of Missouri, Cape Girardeau, which you may or may not have heard of. So I go to Chili's, and I sit at the table with with a staffer, and there's no waitress, there's no wait staff at all. They have a contraption on the table. It says, "Place your order." And it came with mustard, and I like mayonnaise. I think that's one of the great tragedies of this moment. And so I think that there is some general consensus that the AVMs are the new technological way in which some of these appraisals are done, particularly, I guess, with home equity loans, primarily with home equity loans. But I think you can also sense that there's some concern here about that. And so I'm wondering, I don't want to be a troglodyte and, I'm afraid of technology. But what happened in the financial crisis is that the appraisals ended up being far too generous. And so I think in some instances people thought, well, if we can put the AVM, it'll stop that process. But it also removes the humanity from it and also creates some other issues. So, anytime we come up with a new technology, a great technology, I think, and I'm looking for this too, that there has to be some kind of counterbalance to maintain the humanity. And so I'm wondering if most of us agree that this system is somewhat flawed right now, what can we do as a counterbalance?
One of the problems with AVMs is that they can be manipulated, and we saw that in the mortgage crisis. So what happens is they built what they called cascades, so that they would bundle 10 different AVMs into one ordering platform, Well, what would happen is a lender would continue to order an AVM until bingo, he got the number that he needed. So one of my dear friends was an AVM developer, and he had sold his company, and the entity that bought his company said, hey, we need to juice the algorithm because in Florida we're not getting enough hits. So we need you to dial in a 20% appreciation rate in Florida because they only get paid if they get a hit on that AVM. So don't for a minute think that AVMs can't be manipulated and subject to fraud. They just can do it on a wholesale basis rather than one at a time.
Mr. Brady.
I think it's an overall, I mean, there's reform is needed. The appraisal subcommittee is an example. Probably doesn't have enough teeth. They talked about it earlier. There's no enforcement. I mean, you can note a problem in a state, but they need a little bit more authority to take action. States, from state to state, is different. Some have boards, some have funding, some don't. Some sweep the funding on appraisal fees into the general fund and don't fund it appropriately. So there needs to be a better standard. The appeals process, we need a good appeals process because I had an example just 3 weeks ago where I had a plan, new construction. I gave them a cost analysis, $249,000, came in at $234. The reason that came in at $234 is the oversight of not finishing the basement and 9-foot ceilings. Very simple, yet I wasn't able to convince that appraiser to make that change. So we need a very quick and adequate appeal process to at least not inflate the cost.
Is that something we should be doing?
Justify the cost.
Is that something we should be doing?
There should be a standard within the industry, like the VA, like the Tidewater potential, the Tidewater initiative, that allows an appraiser to call, if it's undervalued compared to what the contract might be, to call and ask questions. And we've gone so far away from that because of political correctness and worries that we're inflating the price of a product valuation, that we've gone, as the chairman suggested, the pendulum has swung almost too far to really punish the supply or the provider.
Gentlemen, his time has expired. With that, go to the gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks to our witnesses for your testimony. I was particularly interested in Ms. Trice's appraisal oversight schematic or graph that shows the complexity of the oversight system that we have in place now, and interested in your suggestion of a big and bold plan to overhaul the system. And I do think that that you're right, that sometimes less can be more in terms of actually providing for an accountable system, because when you do have this dizzying maze of agencies and responsibilities, you're dividing lines of accountability, and you're not the responsibilities of the participants are not clearly set forward. So can you just summarize your testimony a little bit more and amplify it to say what would be that big and bold plan that would streamline the system? And do we still need the ASC, the subcommittee, or does it need to be completely replaced with a new structure that you're proposing?
Well, I do call for a new structure, but that doesn't mean that you wouldn't take the components that do work from the current system and put it in this new entity. I mean, we do need licensing of individuals. Lending, however, is national. It's no longer local. And so if we set up a 50-state system, you essentially are, I'll borrow this from President-elect Trump, we're building a wall between each border of each state. So we have to have a system that is portable across all states, and it's uniform and it's standard. So if I get a mortgage in Maryland and I want to move to Delaware, I know exactly what to expect, and the process is uniform. I do subscribe to the theory that people are honest and want to do the right thing, but under the current regulatory schema, they don't even know what the right thing is to do. So, you know, it certainly is difficult to follow the rules when you don't understand the rules and whose rules they are.
Has the Dodd-Frank law, you know, help proliferate the complexity of the regulatory structure, or are there some positive changes there that, you know, what is the impact of Dodd-Frank in exacerbating the complexity?
Dodd-Frank has many positive components. Number one, the appraisal independence requirements are really critical to the appraisal process. The problem has actually been the enforcement of it. So we keep adding new regulations, but we don't enforce any of them. So the result of that is we punish good people, and the cost of compliance has just gone off the charts, but bad actors continue to behave badly.
Well, one thing I keep hearing from constituents, you know, banks, actors in the real estate market, is that there is excessive appraisal requirements that add unnecessary costs to transactions. And I'd like for any of you all to comment on that. In other words, what the complaint that I'm hearing specifically is that there are new requirements, I don't know if they're Dodd-Frank requirements or other regulatory requirements, that require appraisals every time there's a refinancing or every time there is a transaction, even when there's not a material change in the valuation of the property. Can anybody speak to that, or what is the cause of that? And do we need as many appraisals as we have?
Well, we just got through a bank crisis, so that's partly what's going on there, is that we have a lot of failed banks or banks that have been coming up for error, and so the bank examiners have been monitoring, they've been examining those cases, looking at those portfolios, and they've seen a need to kind of get an understanding understanding of the risks that involve there. So having an appraisal to update those files, to understand your risks from a taxpayer standpoint is an important thing. And I think that's a good goal from a safety and soundness standpoint. But from the appraiser standpoint, there's clearly new rules that are hitting appraisers on the head. We see fees that are being passed through to appraisers to be paid for in order to be accepted on an approved list. I mentioned the registry fees that are coming from the appraisal subcommittee. That is going to hit appraisers squarely in the face and be a huge disincentive from practicing in those areas. And financial institutions themselves, too, people don't realize there are a lot of appraisers that work at banks. Bank appraisers have to deal with this complicated regulatory structure, too, and they have to obtain those licenses just as the practitioners do, so an efficient system would be helpful there.
Okay, thank you.
Gentleman's time has expired. With that, we go to the gentleman from Texas, Mr. Green, who's recognized for 5 minutes.
Thank you, Mr. Chairman. Thank the witnesses for appearing as well. Mr. Brady, I was especially interested in your comments. If you might recall, when I gave my opening statement, I dealt with this area of appraisals and appeals, and you have followed up on this. Let's just talk about a possible example to make this clear or clearer if we can. Let's assume that you have an FHA loan and the seller believes that there's a problem with the appraisal. I won't use terms like fraud, but there's a problem. And let's assume that the buyer thinks there's a problem as well. What is the process at that point to allow them to have an opportunity to impact that appraisal?
Well, it varies, and a banker that gets an appraisal that doesn't meet a contract price can ask the appraiser to talk to the seller and just try and justify it. Many times that doesn't occur, and that's where the problem exists. But also in a transaction where you get an appraisal a week before, let's be generous and say a week before closing, and the appraisal's not justifies the purchase price. That process takes much longer. The deal either blows up, doesn't close, both buyers or sellers are unhappy, In a new construction situation, many times the sellers, meaning us, will eat the difference, not justifiably, but in order to close a house because the appeal process or that process is too lengthy to get it done in a matter of time. So where would take place better is in the Tidewater Initiative, where an appraiser would contact the seller prior to issuing an appraisal so that they can either justify or not to inflate the price, the purchase price, so that it doesn't happen at the last minute.
I understand, but is that required? Is it required of the appraiser to have that conversation?
No.
And in a good many cases, that does not happen, is what you're saying.
That's correct.
Now, you indicated that you sell properties. Obviously, you do. You're a builder. But let's just take the homeowner who just has a home, typical person in the United States of America.
Mm-hmm.
If this person finds problems with the difference, that person may not be able to eat. That was a term you used.
That's correct.
To eat that loss. That person may find it unacceptable. At this point, can that person go out and say, well, let me just get another appraisal?
No, they can't. I don't believe they can go out and get another appraisal.
I believe you're right.
But time is of the essence, and they don't have time to justify the actual cost.
Well, it's not just the time. There are other factors involved, too. Ms.
correct.
Wagner, let me let you have, your hand's been up. I'd like for you to respond quickly if you can, please.
Yeah, thank you. One concern that we do have with the appeal process is that we've seen, while there might be some legitimate cases for it, we have seen that type of process manipulated in the past that's led to overvaluations. We've seen lenders contacting appraisers and pressuring them to increase values or telling appraisers that the values have come in too low, and then there have been some manipulation within the system to then come back with
I may
a higher
intercede for just a
value.
second. So we're concluding that we need a balance.
Right.
And there seems to be a pervasive belief that that balance has not been achieved. And that's what I want to work on to try to achieve that balance. I'd like to work with you, Ms. Wagner. I also want to work with you, Mr. Brady, to see if we can achieve that balance, because that's what's critical. And the realtors are telling me that balance has not been achieved. I've talked to homeowners who believe that it hasn't been achieved because once they get the first appraisal, getting another one is not an easy thing to accomplish. I think there's a waiting period before you can get another appraisal. Is that right, Ms. Wagner?
That's true for FHA loans.
For FHA, yes. Is that waiting period about 6 months?
Yes, sir.
Okay, so you're stuck with a 6-month appraisal. You're a homeowner. You're not a builder. You don't eat losses. You're trying to move up in the world. So I want to correct this, but let me quickly say this. I want to move to another area. None of you are here today to say that we should get rid of Dodd-Frank because of your concerns and the consternation that you have with one area of it. Is that a fair statement? Are you here to say you want to eliminate Dodd-Frank? Anyone? If so, kindly raise your hand. All right. Now, I want to go to one specific area of Dodd-Frank. We have a Defense Department in this country. We have a Securities and Exchange Commission to protect investors. Defense Department defends the country. Why wouldn't we have a Consumer Financial Protection Bureau to protect consumers? Anybody here want to get rid of the CFPB today? If you're so, raise your hand. You think that it's just a horrible institution and we ought to just do away with it? Thank you, Mr. Chairman. I yield back the balance of my time. No hands raised for the record on either question. Thank you. I yield back.
Gentleman's time has expired. We welcome Mr. Sherman to the committee today for some questioning. I see he's here and wants to participate, so we welcome him. The gentleman from California is recognized for 5 minutes.
I thank the chair for letting me participate, although I'm not a member of the subcommittee. I'd like to ask the Appraisal Foundation how close you are to releasing new rules for entering appraisers.
We're currently in we call it the exposure draft process. Much like regulators, we issue drafts. We want to make sure we get it right. That board that does it actually has a meeting this Thursday and Friday in St. Louis. My guess, it would probably be spring before it occurs.
Okay. I'll ask this to whatever witnesses would choose to respond. What are one or two facets of the current appraisal system and system of appraisal regulation that you think we ought to preserve that are essential regardless of what other changes might be made?
I'd be happy to take that, Congressman. The Dodd-Frank Act anti-coercion provisions and the appraisal independence provisions of Dodd-Frank are extremely important. I remember living the era of the housing boom, and I think we were on record to Congress with a letter to caution the pending House of Cards as early as 2002. So those protections are important. I would point out that those are part of the Truth in Lending Act. They're not part of FIREA. So when we're talking about making changes to our regulatory structure, we're really referring to the FIREA, the original FIREA statute, and less so relative to Dodd-Frank, particularly those anti-coercion provisions.
Does anyone, Mr. Brady?
I would just follow up. The independence is a good thing, being able to have independence from appraisers, but the problem is if you don't have, you put all your eggs in that one basket on the independents and the AMCs, as some of the panel suggested, we're getting less qualified, less educated, less trained appraisers sometimes in those AMCs. That creates a problem that we have to resolve at least by an appeal process and a very thorough and expeditious appeal process.
I reiterate, appraisal independence is the most important component of Dodd-Frank.
And Mr. Bird?
If I could just speak to that. The problem with the appraisal independence is a great thing. Unfortunately, it also has caused sometimes appraisers to be viewed as radioactive, where real estate agents don't want to talk to them because they're afraid they're going to get in trouble. Lenders don't want to talk to them. As the gentleman was talking about earlier, you need that communication between the appraiser and whether it's the lender or the real estate agent or the homeowner so that he has as much information. Talking to an appraiser is not coercion. It's communicating, it's giving information.
Thank you. What can be done to encourage appraisers to work in rural areas to address supply issues? Mr. Garber?
Well, make their lives easier, for one, and more productive and profitable would be helpful. Stop imposing new rules and mandates on how they do their job relative to the methodologies, particular, because those rural areas are very complex. An appraisal in Washington has vast amounts of data. You have a lot of conforming markets, whereas in a rural area, you might have data access problems, and there might be limitations with the data. But the notion of trying to codify the appraisal process, including the methods that they're using, how to use the sales comparison approach as an example, in those markets, that's a disincentive to entering the profession. That's why appraisers enter the appraisal profession, is because they're paid to provide their professional expertise. They're trained, they know appraisal and valuation, and they should be allowed to do their jobs and use their professional judgment, not follow a set of rules like a cookbook.
I understand. Let's hear from Ms. Wagner.
I think that these overarching standards are actually really necessary for appraisers, and I've worked with many appraisers in my largely extremely rural state of West Virginia, and the regulations have never been, and the USPAP standards have never been addressed to me by honest, hardworking appraisers. They've never said that there's a problem with the USPAP standards. There is room within those standards for rural communities, for areas like this, and there's a real need to have that guidance. And so that's something that I've heard from appraisers who want to do the right thing, and any kind of flexibility with that would be used by the dishonest folks who want to get away with something, is my understanding from that market.
I want to sneak in one other concept. Should we change the rules to allow interstate work more easily? Yes, Ms. Trice or Mr. Park.
In specific to commercial work, definitely. If I'm an expert in appraising a golf course, for example, and I'm on the East Coast and I get called to, there aren't that many golf courses in the United States, I have to apply for a license.
I hear the administration is going to see to more, but go on.
Yeah.
There are already, excuse me, there are already rules in place for appraisers to be able to apply for reciprocity between states. Okay. And that process has become much smoother and much better over the last several
I believe my time has expired. I thank the chair.
We thank the gentleman. We have a second round planned here. The gentleman from New Mexico has got some very salient points he'd like to make.
Thank you, Mr. Chairman.
He's recognized for 5 minutes.
All right, Ms. Trice, I don't mean to be picking on you, but you seem to be kind of a straight shooter. So I would, from this side of the aisle, from this side of the table, when I read the statement by Ms. Wagner, and I'm kind of wanting you to help me evaluate that, it says it's common knowledge, page 2 of the testimony says it's common knowledge that lax regulation of the mortgage and appraisal market led directly to the financial collapse of 2008. Prior to the collapse, unscrupulous mortgage brokers and lenders joined forces with a handful of appraisers to fraudulently inflate home values. So from my perspective, looking at a thing that runs into the hundreds of billions of dollars and maybe nibbles into the $1 trillion range when you look at home values, is it possible for a handful of appraisers to have done that?
No, not
Okay.
all by themselves.
Yeah, it's,
If I may actually respond to that.
well,
Since you
I
are using
appreciate
my
it.
language.
I'm just reading your statement.
I know, and I would like to be able to clarify.
Mr. Park, actually, I really wanted to direct myself now to the time element that Mr. Green got into. So when you all are checking the states out, do you measure the time from the initiation and you get sort of a trend across the nation that this state takes 1 day, the state takes 6 months or whatever? Do you do that kind of an analysis?
In terms of handling complaints?
No, the terms of the appraisal process, how long it takes.
No, that's not something that the subcommittee has the authority to delve into in terms of the,
Okay.
the states. And
Okay, but you do keep a registry of people, of
we maintain a
appraisers.
national registry of appraisers who are eligible to perform
And
appraisals for
so
federally
Mrs. Trice
related
made a comment
transactions.
that bad actors continue to act badly. Do you ever take people off of that registry? And what's the process by which you take them off?
We do. In cases where appraisers are found to be not compliant with the requirements, we will remove those. In limited cases, those appraisers can be removed from the registry.
And you take the state's information for who's compliant and who's not, or you track your own compliance and non-compliance?
We take the information from the states. The
How many have you
Dodd-Frank Act
taken?
also gave the subcommittee additional authority to remove appraisers and AMCs from the National Registry on an interim basis
So-
in lieu of states
All right.
failing to act.
So again, going back to the assertion that the appraisers were a key piece of the collapse of 2008, how many appraisers did you pull off out of your registry for bad acting?
Again, we haven't pulled off any appraisers on a permanent basis for bad acting, as you put it.
So you're-
Regulation of appraisers resides within the states.
I understand, but you're the one that keeps the registry. That's what your paper says. So, and you said you had taken people off of the registry, so my question is, how many have you taken off the registry?
The registry is populated by the states. The appraisal subcommittee does not enter the data into the registry.
It says the ASC is required to maintain the registry?
We maintain the database and the states populate it.
All right. So, one of the things in your testimony that you do say is that you're in the process, or that one of the things that's greatly needed is to streamline processes, streamline and stabilize the appraisal standards. Now, is that something you all have attacked, or is it something you just identified that needs to be attacked?
It's something that we have identified as an issue, along with all of the other requirements that are placed upon appraisers. If we could get to a point at some time in the future, a point
Okay.
of stasis where there aren't as
All right,
many changes
I get
going
the
on,
point.
it would make
I'm running out of time. So, Mr. Garber, Mr. Park said that 25 years is not hardly, just barely a glimmer in a matter of bureaucracy. I'm kind of paraphrasing it. When I look at Uber, it didn't exist 5 years ago, and now it's worth about $67 billion. So markets are really generating fast, and this idea that we can't get a coherent way of regulating in 25 years, is that something you agree with or disagree with?
I think there's clearly a better model that Congress has recognized recently, and that's the nationwide mortgage licensing system
All right.
to the states.
Thanks, appreciate it. Yield back, Mr. Chairman.
Gentleman yields back. With that, we have the gentleman from Texas who's got a second question. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Wagner, you had something that you were trying to complete. Would you want to do so now?
Thank you, sir. I just wanted to point out that I think that there are some really important market forces at work, and maybe when I said a handful of appraisers, I was discussing in West Virginia, there were some identifiable bad actors. But I think that the market forces at work really created a situation where the lending industry was able to put substantial pressure on appraisers that compromise their independence and compromise their ability to provide adequate values. And so with the requirement of appraisal independence in Dodd-Frank, I think that that really helps to ensure that there is some independence there and that those market forces don't interact in order to put pressure on people to increase values or change values. And in addition, I think that the uniform standards of professional appraisal practice help create standards that appraisers can be reviewed according to and can ensure that there is adequate protections in place for both consumers and homeowners and the economy as a whole. So I think that both of those systems are very essential.
Thank you. I do agree with what you've said. I would add this. We do agree, I believe, that from time to time, even the best of us can make mistakes. And much of what we do is based upon not only some standard, but also some evaluation that is subjective. And when those mistakes are made, we would want to have a process by which they can be corrected. I was a judge for 26 years. I thank God that there was an appeals process. Over the 26 years, I was not perfect. I was better than everybody else, however. So the point is that we do need to have a methodology by which we can achieve the balance. And that's what I'd like to work with you on. Ms. Wagner, I really like your input, and I'd like yours too, Mr. Brady, because I think between the two of you, we can strike that balance. Now, let me go over to Mr. Park. Mr. Park, just to get some understanding, first let me start with this basic premise. Do you agree that most people who commit fraudulent acts, that they don't expose themselves, that they pretty much decide that this is something they'll keep to themselves or they'll keep it within a certain circle of people? And I mention this because there seems to be the belief that you have the responsibility of eliminating fraud and that you're some sort of cop on the beat. I don't think that's your function. Am I correct?
No, I think that the appraisal subcommittee should have a role in preventing fraud whenever it can and has the authority to do so. But that authority largely resides within the states in terms of dealing with the individual transactions where fraud might occur.
Right. And my point is, however, that if it comes to your attention, if you have the opportunity, you would act. Is that a fair statement?
We would act within the confines of the law, absolutely. And we have tracked fraudulent reports of appraisal fraud in the states so that we can work with the states when that becomes a real problem, again, through a partnership, not from the perspective of the federal government telling the states how they should handle their problems with fraud.
So you're not the supervisor. You work with, you don't dictate to.
It depends on the issue, but when we do have the authority, we do act as in a supervisory role.
Mr. Park, excuse me. Let's talk generally speaking, if we may. Generally speaking, do you supervise the activities of the states?
Yes.
And when you supervise the activities of the states, are you responsible for ascertaining whether or not fraud exists?
We are not directly responsible for that, no, sir.
Okay. That's the point that I've been trying to help you make, Mr. Parks. You're not the guy who acquires the empirical evidence to move forward. Is that a fair statement?
That's correct.
That's the point, Mr. Parks. There are people who seem to be attributing this to you.
Point well made.
Thank you, Mr. Parks. I'm going to yield back, Mr. Chairman.
Gentleman yields back. With that, we will go to the another gentleman from Missouri. You guys are being inundated with us today. Mr. Clay is recognized for 5 minutes.
Thank you, Mr. Chairman, and wanted to ask the panel, according to an educator at the Appraiser Institute, the average age of an appraiser is 55 years of age, and the main barrier for entry into the profession is the requirement of employment. The employment requirement is an appraiser trainee has to work under a certified appraiser for 2,500 hours at a minimum of 2 years. So even if a person completes the educational process successfully, they still face a barrier of finding employment to complete the on-the-job training requirement. My questions to the panel is, how can we create an environment to help appraiser trainees to complete the employment requirements to become a certified appraiser? And I guess I'll just start with Mr. Park and go down the line.
Well, it's important that the appraisal regulatory system continue to look at new ways to bring people into the profession. There has been a lot of progress made in terms of the requirements for appraisers to enter the profession, in terms of increasing those requirements. Mr. Bunton can speak to this also, since it's the Appraiser Qualifications Board that is setting these requirements, but they've established a national uniform licensing exam. They've increased education requirements, and now they're looking at reducing the experience requirements, which historically have been a significant barrier to entry because it is difficult to find a supervisor to train you as a trainee, get the necessary hours for your credential.
Thank you, Mr. Button.
Yeah, the problem we have generally is also users of appraisal services do not want to engage trainees. So if I'm owning an appraisal firm, I don't want to have trainees because they're really not much value to me. As far as the experience requirement, 2,000 hours you mentioned, that is sort of a last vestige from an apprenticeship type operation. We're moving to a profession, and our board is looking at case study courses and also an exam where you could test out essentially of a lot of that time, and you become more valuable to an appraiser as a trainee much quicker than the 2,000 hours over 12 months.
And Mr. Button, I guess one of my concerns is that it adds an extra burden when you try to strive for diversity in this profession. Being a former realtor, we rely on appraisers quite a bit. So I was wondering, has that issue arisen in your industry, and has anyone tried to address it?
We have, on several occasions, we actually solicit, we have four boards that we have to populate every year, and we solicit it. We solicit minority groups, we solicit all types of people to get as many qualified applicants as we can get in there.
Thank you. Ms. Trice, anything to add?
The only thing to add, I think it's a couple of problems. We have set the bar too high. The number of hours required to work with a mentor, you can actually become an airline pilot and have less experience, but you're responsible for several hundred souls, and nobody's ever died in the appraisal process, to the best of my knowledge. But the other problem is really an economic one, and we've had a compression of fees, and it's a very complicated topic, but we have a component of Dodd-Frank that on customary and reasonable fees that has never been enforced, and so we've increase the requirements for appraisals, but they make about half of what they used to make. So nobody's going to want to enter the profession with that kind of economic environment.
I see. Mr. Garber, has the Institute done anything to try to make the workforce?
Yeah, absolutely we have. It's punitive right now to take on a trainee, very difficult process. We have there's rules, regulations have been built up around that process. We do need simplification of that. those could be modified significantly. We have offered, and we don't agree with the Appraisal Foundation on everything, obviously, but an area that we have been talking with them very closely is on the development of an experience alternative, or to earn experience in a classroom situation in a tested environment. So to actually enable where you can't find a mentor-mentee relationship, to actually earn that experience in a classroom under a tested situation.
Wonderful. Can they complete?
Well, I would just add, in regard, training is important. I don't know the number of hours, and I'm not in the professional business of appraisals, but where you go to the AMCs and you have a pool of appraisers, doesn't mean that their expertise is new construction or existing, and so we have to maybe look at that more in detail as to, if I have a new construction product, I get into pool, they've never done a new construction, so training and continuing education on this process is very important.
Thank you. And Ms. Wagner, anything to add?
Just briefly, I think from talking to appraisers in my state, I think that having some compensation for supervisors would be helpful, because I think it is very costly for people to bring on new trainees, and that they're not getting adequately compensated for that.
And thank you all very much for your response. Mr. Chairman, my time is up.
Could I make one comment to that?
Sure, go ahead. Briefly.
One of the issues that we're grappling with right now is trying to educate lenders on the ability for lenders to use trainees in their transactions. Historically, trainees have served as that force multiplier for appraisers. Once you get a trainee trained to a certain level where they can do the inspections and they can do some of the analysis and data gathering without that supervisor being involved every step of the way, it makes it much more economically viable to bring on trainees. Right now, there are requirements that are outside of the federal government that limit the ability of trainees to be able to participate.
Thank you.
Thank you. With that, I've got a couple follow-ups, and then we'll wrap up here. Mr. Garber, in your testimony, you argue in favor of limiting the activities of the Appraisal Foundation to prevent potential conflicts of interest. Can you explain what those conflicts of interests are?
Sure, thanks for the question. Whenever you have a statute that recognizes an entity, there's a potential, obviously there's great responsibility that's given to that organization, but then there's also a great privilege that comes with it. So if you get special standing and recognition, then they're given recognition and powers. The public looks at them in a certain respect as an authority in certain areas. And it's very common to address that for Congress to set forth limitations in particular areas. The limitations are important because it helps level the playing field. It doesn't give one organization an advantage over another. That's where we've been expressing concern relative to the move to create a third board under the Appraisal Foundation, the Appraisal Practices Board. That's a board that was directed by the Appraisal Subcommittee for the Foundation to undertake, to develop rules around methodologies. At the same time, the Foundation was setting up an education arm to offer education around those entities or those valuation advisories. We were concerned that was essentially setting up a situation where there's too much centralized authority. So if you have centralized authority in the areas, the full range of valuation, including standards, qualifications, and the methodologies, there's just a very strong potential for conflicts of interest to exist on education and on credentialing. And Congress has recognized that, as I said, in the SAFE Act, under the nationwide mortgage licensing system, there's a very strict prohibition for the Conference of State Bank Supervisors to not get involved in education activities. The same thing under the National Association of Registered Agents and Brokers. NARAB has a very similar provision because, again, it's a nonprofit organization. It's supposed to be a neutral. It's given special standing in the industry to be a neutral body within that universe. But it comes with responsibilities and privileges, and we ought not set up a situation where we're tilting the scales and giving an advantage to one group or to the other.
Mr. Park, do you want to?
If I may correct the record, that's the second time Mr. Garber has indicated that the subcommittee directed the Appraisal Foundation to establish the Appraisal Practices Board. That is not the case. There was a meeting, this predated my time at the subcommittee, but there was a meeting of the subcommittee where there was a discussion regarding the need for appraisers to have additional education regarding, at that time, the hot button was declining markets. And the federal regulatory agencies were seeing problems with appraisers' ability to handle appraisals in declining markets. The subcommittee never in any way directed the Appraisal Foundation to establish the Appraisal Practices Board.
Mr. Bunton, I'm sure you've got a comment.
Thank you. I'd just like to address the conflict of interest issue. I think their testimony references a course approval program, which we put in place primarily at their behest. They also mentioned we shouldn't be in education. They developed courses for us and donated them to us. And as far as the Appraiser Practices Board, most appraisers do not belong to a professional society, and that board issues voluntary guidance, free of charge, and no federal funds. The story behind the story here is that in 2010, they were faced with suspension from the foundation for conduct. They resigned rather than face suspension. So now, while they were once an advocate, they have become an adversary, unlike the other 95 organizations affiliated with us.
If I could,
Okay,
Congressman?
no, I think we're going to move on. Mr. Park, we want to clarify what you've been saying with regards to the registry. Apparently, one of your statements said that you had the ability to take people off, and now you're saying the states are the ones that really put people on and off. What's your final statement here?
Under certain conditions, the Appraisal Subcommittee does have the ability to remove an appraiser from the National Registry.
Okay, what you're saying is under Dodd-Frank, you do have the authority to take them off.
Dodd-Frank gave us additional authority to remove appraisers and
Okay.
appraisal management companies from the National Registry for up to 90 days in lieu of state action.
Okay.
So if a state was simply refusing to take action against an AMC or an appraiser who had demonstrable issues, then the subcommittee could take such an action.
Okay, so what you're saying is normally the state takes care of all this, but you are the remover of last resort, so to speak?
That's correct.
Okay, all right, very good. Thank you. That ends my questions, but I do have some comments here. I appreciate everybody's time today. You guys have been great. It's been a very spirited discussion, and I think it shows that we certainly have some issues here. You know, 08 showed that there were some problems in the appraisal industry. Dodd-Frank was an attempt to fix it. Like any bill, it's well-intentioned. I'm sure there are some tweaks that need to be done. Some good things that came out of it, and it's probably not some good things. And so we want to work with you to find solutions to those things that don't work, to make sure that we fix them. We've had everything from blow the system up to just tweak it a little bit. So it's made for an interesting discussion today. But at the end of the day, we have to maintain, the appraisers need to maintain their independence, but they need some flexibility. Ms. Wagner made a comment a while ago that flexibility is bad, and it leads to fraud, which impugned the integrity of every appraiser out there, which I thought was remarkable. It was breathtaking, actually. But I think that generally, you know, the appraisers are caught in a bind from the standpoint that what you do is give a snapshot in time of what the value of that property is today. Tomorrow, that property will be have a different value. It could go up, it could go down. I have a daughter who lives in Denver, Colorado. And all of you know Denver is a market where the real estate just keeps going up and up and up. She's built a new house 3 years ago and can probably have close to a 40%, if not 50% increase in value in that amount of time. Now it's value. The price of construction hasn't gone up, but the price of the value of the home has gone up. I live in rural Missouri. I can tell you we have a real problem with appraisers. We have no appraisers in my county, period. We have a county of 25 to 30,000 people and no appraisers, zero in my county. They are gone. I said a while ago, I have a friend who is in the business, and it is very difficult, as you've talked about, to get past the certification problem. So it tells me we have some difficulties. And at the bottom line is we have to have appraisers to make sure that there is a trust in the value of the property and the people who buy it and finance it can believe in the value of that property for that day. And so we want to work with you, and we want to continue to have this discussion, and we certainly appreciate all of your being here today and having this, I think, very spirited and very informational discussion. Thank you. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, this hearing is adjourned.